everyone, this is Krista. Thanks for tuning in. If you're new to this channel, I mainly talk about combining my quest for financial freedom with my equestrian passion. I discuss everything from investments and financial planning to making decisions about horse ownership and equestrian education, and how to combine and prioritize your finances with your equestrian hobby. If this appeals to you and you would like to join me on this journey, feel free to subscribe to the channel and hit the bell icon if you'd like to be notified every time I post a new video. Today I'm going to be talking about the sell-off in the stock market due to the coronavirus and whether or not we should be worried. I will be summarizing and reviewing a couple articles by Sam Rowe of Yahoo Finance. One came out yesterday, yesterday being February 27th. By the time I post this video, it may be later than February 27th. However, that article is entitled, "Something Dangerous is Happening Beneath the Surface of the Market Sell-Off." The other article that I will be reviewing was also authored by Sam Rowe of Yahoo Finance, and that was released on February 24th and was entitled, "Warren Buffett Warns Coronavirus Will Affect Business, but He Certainly Won't Be Selling Stocks." And for those who know me, Warren Buffett is one of the financial people that I follow. He adopts a value investing philosophy, and basically he looks at the underlying fundamentals of a stock, so he is not concerned so much with market conditions. So we will be discussing these two articles and summarizing them and what they mean for us as investors coming up. Okay, here's the first article I'm reviewing. It's entitled, "Something Dangerous is Happening Beneath the Surface of the Market Sell-Off." And I'm going to play you this part of the video clip, which is attached to the article. It's from Peter Shearer. He is the head of macro strategies for Academy Securities, and he is also a freelance commentator for Forbes, Bloomberg, and other financial publications. Here's the clip.
Right, that changes in correlation, in your view, are more dangerous than just an increase in volatility. And along those lines, are you seeing, like, what kinds of changes are you seeing right now? Or is everything moving in one direction at the same time? What concerns you?
I think for the last few weeks, while we've had this volatility, we've definitely had stocks zig while bonds zag. So every time stocks went up, bonds sold off, and vice versa. And all of a sudden, that behavior changed a little bit into the close yesterday. And making it even more dangerous to me, you saw gold sell off into the close, commodities were selling off, even Bitcoin was selling off into the close. And to me, I think people run their portfolios, especially these risk parity type strategies, where they're comfortable. If your stocks are moving one direction, your bonds the other, your portfolio is performing as it should. If you start getting these correlations to break down, I think you just see selling across the board, and that's what we're not prepared for at all.
So basically what Mr. Shearer is saying is that in a typical market downturn, when values of equities like stocks drop, the value of other asset classes like bonds, bitcoins, commodities, and gold go up. But with this coronavirus event, people appear to be cashing out of all asset classes. If you look into the indexes at the top of this article, and I'm going to blow them up a bit so you can see them better, you will indeed notice that all of them, regardless if they are the S&P 500, the Dow, gold, silver, or commodities, they are all dropping. So here I am on the Yahoo Finance page a couple days later after my initial recording, and it's March 2nd here, and I'm going to go ahead and scroll through these uh, indices right now. So here it is. It's 4:20 in the morning. So the S&P futures is down again. The Dow is also down 175 points. This is the future, so that is also not looking well. NASDAQ also down 37 points. Let's see. The crude oil is up. Gold is up. So that's not looking like the crash in all asset classes. 10-year bonds is neutral. GDP is down slightly. Cryptocurrency and Bitcoin. Bitcoin is up. Bitcoin is up. Cryptocurrency is down. So since that article was released on February 27th, we're now 5 days later. So it's not, his prediction is not totally true at this point in time. Everything's not totally crashing. So we're going to just look at this and go from here. In this screenshot, I've built a portfolio of short-term bond ETFs. This is again on March 2nd, so 5 days after that article, Mr. Yo's article was released. And I just wanted to show you the differences in the price increases and decreases in a couple of the short-term bonds. Some of them are up and others are down. Now, you will notice in bond fluctuations with respect to stock fluctuations, the bonds don't fluctuate as much. They're not as volatile as the stock fluctuations in market conditions. So they always seem like a better, a more conservative and secure asset class than stocks in the short term. So, and then these short-term bonds, they're less than, I think they're less than 3 years, 3-year term bonds. So they are extremely short. Their equivalent is similar, not quite as secure as cash, although cash does depreciate in value over time, but they are a fairly secure asset class. I'm going to look at the ones that are increasing in value during this time. And keep in mind, this is all in the futures because it's only 4:41 in the morning here. And what futures are, it gives you some indication of how the market is going to perform because they are for trades that occur before the market opens. So this one here, I'm going to go ahead and take a look at it. This is the iShares short treasury bond. So this is a treasury bond, which is really secure compared to other types of bonds, compared to like a corporate bond. Mint is 0, so it's neutral there. We're a little bit up on the Vanguard short-term corporate bond index. And of course, the Schwab, more Treasury bonds here. And then for the municipal bonds, we're down. Those are local government bonds. They're not taxable. TIPS, that's inflation protected bonds. And BSV short-term bond index. I think that's kind of a whole, kind of encompasses everything as far as short-term bonds go, with a mix of both treasury bonds and corporate bonds. Okay folks, I'm about 11 minutes into this video and it's getting a little long, and I want to give you a value viewing experience, and I don't want you to get bored. I know these market statistics can be a little hard to digest sometimes, so I am going to save the other part of this video for a part 2. So Sam Rowe's other article on Warren Buffett, I'll try to put that together in the next few days. The great thing about that part of the video is that Warren Buffett's philosophy is pretty much evergreen. He focuses on company fundamentals and the value of the profitability of the business long term. So if you look at a company's value, whether or not they are profitable, they keep debt under control, I don't think you need to worry too much about the coronavirus in the short term. We don't know how long this coronavirus is going to last. A year from now, the situation might be totally different. So if you want to save some time by not watching my next video, that's the moral of the story, is that if you're looking at an investment platform long term, you don't need to be too concerned. And it might even create some buying opportunities where you can get great equities and great businesses for bargain basement prices. So that's it for today. We will have a part 2 on this video. If you like the video, I know it was kind of all over the place, but if you like it, please press the like key. And if you want to see more of these videos, please press the subscribe button. And if you'd like to be notified every time I post a new video, please press the bell. So that's it for now. Think outside the dressage court and stay inspired. Bye for now.